If you don't understand this key concept, then you're going to continue to blow all of your funded accounts and all of your evals, just like 95% of traders. When I first started trading, before I was getting consistent payouts, I had an entry model, and anytime I saw that entry model, I was just immediately taking the trade, and I was getting absolutely cooked. And I thought it was the strategy. I thought maybe the strategy doesn't work, so I went to different strategies. But what I didn't understand is that context matters more than any signal or entry signal that you may have. And so in this video, I'm going to go over why context matters more than any signal, and hopefully you learn something from this video if you're a newer trader that could potentially help you have a better equity curve and maybe find some success. Now, most traders think that their edge is their entry model, but in reality, the edge starts before the setup even appears. So most traders lose because they treat every condition like it's the same market, but we have different environments, we have different regimes, and that's something that we need to take into account. So professionals define edge as environment plus location plus participation plus execution. Signals do not create the edge. The filters before the signals actually create the edge. And so what is edge? Well, edge is just positive expectancy over a large sample. So if you want to know the actual formula for it, it's win rate times the average win minus the loss rate times the average loss. And the edge is going to degrade when the win rate drops, when the follow through decreases, when loss frequency increases, and when chop increases variance. So environment is going to directly impact expectancy, and the same setup performs different across regimes. And so the way that a lot of traders like to look at it is they just want to know the entry model. What's the entry model? How do you enter a trade? And so they look for that signal, then they try and justify it, and then they enter, and then they manage damage. The correct way that we should be looking at this or approaching the market is first you classify the environment, and then you identify location, and then you confirm participation, and then you execute. The signal comes last, not first, and confirmation does not override context. So how do we classify environments? What type of environments are there in the market? Well, there's three primary market environments. The first one is initiative expansion, the second one is balanced rotation, and the third one is low participation or compression, or what some people may consider chop. Now, all trading conditions basically fall into one of these three states. So your model most likely does not perform equally across all three environments. So what is initiative expansion? Initiative expansion is a directional auction where price is discovering value. These are things like trending days, or where we see price essentially have higher time frame alignment, the breaks are going to hold and extend, pullbacks actually resolve, and there's acceptance outside prior range. And there's also follow through after imbalance. And so in an initiative expansion, the best type of models for this type of environment are going to be continuation models. They're going to perform best. And you can use reversal models, but they're going to require extreme location. In this type of environment, you have lower chop, you have cleaner invalidation, and you're going to have clear directional bias. Now let's take a quick break to talk about the sponsor of this video, prop firm match. If you trade prop firms, you already know how confusing it can get. There's different prop firms, there's different challenges, there's different rules, and a lot of conflicting information. Prop firm match simplifies all that by putting everything in one platform. They have comparison tools so you can compare prop firms side by side or even challenges side by side, where it even lays out all the rules for you to see, so you know exactly what you're going to be spending your money on or what you should be buying before committing any of your money to anything. You can review the rules side by side and see which prop firms are actually popular by reading some of the reviews from other traders just like yourself, so you don't have to go and spend any time digging through all these different websites. So instead of guessing or hoping that you pick the right prop firm or the right challenge, you can make a decision with everything laid out in one place. If you want to use prop firm match, there's a link in the description and in the pinned comment, and make sure to check out their exclusive offers so you get the best deal on any of these prop firms by using code MATCH. Now let's get back into the video. Now, what is a balanced rotation? Well, a balanced rotation is essentially where we're in a range. It's where you have two-sided auction around an established value. So some observable characteristics of this are going to be repeated rejection at the extremes, mean reversion behavior, And where breakouts or breakdowns fail, and there's going to be overlapping structure and both sides are active, meaning both buyers and sellers are active in this area. The best type of model fit for this is going to be the reversal at extremes. Continuation models are going to degrade in this type of environment because there's more false breakouts. So you're typically going to see higher whipsaw, smaller average extension, and more false breakouts. Now, what is low participation or compression? This is essentially chop. This is essentially where there's insufficient participation to produce sustained auction outcomes. So some things that we might notice in an environment that is low participation or compression is there's tight overlapping candles, there's multiple micro breakouts that fail, and then there's imbalances without continuation. The tape may even be slow, liquidity may be thin, and there's no acceptance outside of structure. And in this type of environment, most models will actually degrade, and edge is statistically reduced because there's high noise, there's poor follow through, and there's going to be frequent stop outs. Now, I trade order flow. So order flow is an amplifier, but it measures participation. It does not create participation. And so in expansion, it's going to confirm direction. In rotation, it shows that two-sided activity or the activity between buyers and sellers. And in compression, we're going to see events occur without any sustained movement. But order flow reliability decreases in compression when participation is low, when the follow through is just totally absent, and when the auction is balanced, at least for the way that I trade it. Now, the common mistake that people might make is they may say that they entered a trade because they saw a stacked imbalance, or they saw absorption happen, or they saw a delta flip. And the assumption is that the signal guarantees follow through. But in reality, signals represent short-term activity, and the follow-through requires structural alignment. So a valid signal in a misaligned environment has lower probability of extension or lower probability of working out. So then how do we think about these environments? Well, we're going to go over something called the model environment fit matrix. We're going to talk about continuation models, reversal models, and scalping models. In a continuation model, like I mentioned earlier, it's going to be strong in initiative expansion. Why? Because the directional auction is going to actually provide us the follow through needed for a continuation model. Pullbacks are going to resolve rather than reverse. There's going to be acceptance that supports the continuation, and risk can actually be defined under structure. So the edge driver for this is going to be sustained participation and structural alignment. Now, the continuation models are weak in balanced rotation, and the reason why is because breakouts will frequently fail. You're going to have two-sided activity that limits that extension for a continuation, and you're going to have mean reversion tendencies that reduce follow-through. And lastly, trend logic conflicts with range logic. So the edge degradation is the win rate drops due to failed continuation attempts. So if we notice that we're in a balanced rotation, we may want to reconsider trying to take a continuation model. Now, a continuation model is going to be poor in compression because there's no sustained displacement. We need displacement for a continuation model, and there's going to be micro breakouts that repeatedly fail. The follow through is going to absolutely collapse, and targets rarely get hit before reversion. So if you're trading a continuation model in compression, you're going to have frequent small stop outs with limited expansion potential just due to the environment that we're currently in. Now, for a reversal model, it's a bit different. So it is selective in initiative expansion. And the reason why is because initiative pressure is dominating. So most counter trend signals are absorbed, and reversals require exhaustion plus failure of continuation. So a reversal model in initiative expansion is really only going to be valid when there's higher time frame extremes that we can watch, and there's extended moves relative to the session, and there's clear acceptance failure. So the edge driver for this is auction failure. It's not just a footprint signal. It's not just a signal. We're watching the auction. Now, a reversal model is going to be strong in a balanced rotation at extremes. Why? Because auction rotates around value. So the extremes often reject, and there's liquidity pools sitting at range highs and lows. The mean reversion tendencies are structurally supported that are going to help with reversal models. So two-sided participation is going to create those opportunities to fade. But again, in compression, it is weak because the extremes are poorly defined, the breaks are going to lack commitment, rejections lack displacement, and noise overwhelms structure. So again, even in compression, when you're using a reversal model, there's going to be frequent small reversals that do not extend. If we decide that we want to have a scalping or micro model, then the way that we have to understand this is a little bit different, because in a scalping or micro model, it's moderate in initiative expansion. And the reason why is because the trend provides directional bias, there's micro pullbacks that offer continuation entries, and there's going to be short bursts of momentum that do exist. So the only limitation with this is that late entries do get punished if we're chasing. And it's also going to be moderate in balanced rotation because both sides are tradable at extremes, the micro mean reversion exists, and smaller targets will fit the range conditions. But the limitation to this is that the profit ceiling is capped by the range width. If you're scalping or doing a micro model, it's highly sensitive to compression or low participation. And some characteristics of compression, again, are just overlapping structure, reduced range expansion, there's going to be failed micro breakouts, there's inconsistent follow through, and thin or erratic liquidity. And it actually affects scalpers the most because scalping relies on small bursts of displacement, and compression reduces displacement magnitude. And if your average win is going to shrink faster than stop size, then that's going to cause a problem. Signal frequency stays high, but expectancy erodes rapidly, because mathematically, if we're in a compression, if your average win drops from 5 points to 3 points if you're scalping, but your stop remains 4 points, then your expectancy is going to collapse, even if the win rate remains similar. So compression does not necessarily eliminate signals for scalping or micro models, but it's just going to degrade the payoff efficiency. So if you have a high trade frequency, but you have low displacement, it's going to basically give you death by friction. So the point is just that no strategy is regime agnostic, and model performance is entirely environment dependent. And if you do not classify environment, then you are unknowingly changing your expectancy curve. And so knowing this, then we have to understand that there are times that we should trade and there are times that we should not be trading. And not trading is part of the edge. Not trading is a position. And so structural no trade conditions are going to be things like multiple consecutive failed breakouts or overlapping structure with no expansion, repeated return to value, no higher time frame alignment, no clean location, inability to define continuation path. And so when 2 or 3 of these things occur, expectancy is degraded. So passing on these types of environments are going to preserve our capital distribution. So then what is the decision tree that we have to really consider when we're trading and we're watching the market? Well, the first step is that we have to think, what environment are we currently watching? What environment is present? Now, does my model fit this environment? And is there meaningful location for me to execute in this environment? And lastly, is participation aligned with structure? If the answer to any of these questions is no, then you pass. You just don't trade it. Because even if you see your signal, you do not trade it. Or your entry model or whatever, you do not trade it. Why? Because execution is conditional. And our participation in the market is going to be optional, but our risk exposure is controlled. We want our risk exposure to be controlled. And so when you're having a strategy, your edge includes invalidation conditions. Your edge is going to include when you should and should not trade. And you need to define when your edge works or when your model works, when it degrades, and when it is inactive or you shouldn't even be trading it, regardless of if you see an entry signal on your chart. Because if you can't define when your model is inactive or when you shouldn't be trading it, then you don't have an edge. You have a pattern preference. And what professionals do is they increase aggression only in aligned environments, and they're actually going to reduce their exposure in misaligned ones. And the final principle is essentially just signals and entry models are execution tools. Environment is the filter, and the filters are going to protect our expectancy, and they're going to protect us on our equity curve. And not trading is not hesitation, it's just statistical preservation. It is a position, it is part of the edge, and so we need to constantly think and remind ourselves that there are times where statistically our model or whatever we're trading may not be in the right environment. And if it's not in the right environment for us to try and execute that model, then we pass. We save ourselves money lost or a headache, or you trying to get out a drawdown, because edge is not frequency, it's conditional participation. So our participation in the market needs to be conditional, only when things align, only when the environment aligns with what we're trying to do, only when our model, whether it's continuation or reversal, makes sense for what we're trying to do. Because oftentimes, let's just say you have a reversal model that you're trying to force on the market while we're in initiative expansion, and you just keep going short when the market is pumping, then you're going to get absolutely destroyed, and vice versa. Now, like we went over, reversal models do work sometimes in initiative expansion, but you have to be selective with it, and it requires extreme location or understanding on the higher time frame extremes where that location may be for us to try and attempt a reversal model. And the same goes for if we're range bound for the day and you keep trying to trade a continuation model. Let's say your model is you trade breakouts of the range, and every single time the market goes to break out of a range, you enter a trade for a continuation and we snap back into the range. And you lost going short, then you lost going long, and then you lost going short, and then next thing you know, your account's gone. So the whole purpose is, if you have an entry model and it works for you, great. But just understand that we have different market environments, and realistically, your model probably isn't going to work the same in all of the market environments. So we need to be selective on when we do decide to participate, and our decision tree needs to be in the correct order so that we save ourselves from losing money that we didn't need to lose. Now, if you want to understand how exactly I frame my context and my structure before I even look at footprint, before I even consider taking an entry, I actually have a framework PDF that I created that I'm going to include in the description below. It's free. You can download it, you can read it, and that's about it for this video. So I will catch you guys next time. Until then, peace.